Okay, let's dive right into this explainer. I want you to picture a scenario that is honestly probably way too familiar. It's 11:14 p.m. on a Sunday night. Nothing in your house is actually on fire. There are no immediate emergencies, but there you are, lying awake in the dark, doing what I like to call the Sunday night math. You know what I'm talking about? You're crunching the numbers in your head. The mortgage, the car payment, the groceries. You're trying to figure out if this is the month you finally get ahead or if you're just going to keep treading water like you have been for the last 3 years. You're doing this because you feel what we call house poor, and you're lying there wondering why adult life has to feel like this constant, exhausting, low-grade financial panic.
But here is where it gets super fascinating. We really need to contrast your Sunday night stress with the neighbor living right down the street. This neighbor makes the exact same salary you do. Literally, the exact same. Yet they woke up last Tuesday and just decided to take a week off work with zero panic. No frantic emails, no midnight math. And the secret here, it's not that they are secretly rich or have some massive trust fund. It's simply that they aren't trapped by the same systemic financial pressures. They have fundamentally opted out of that midnight math. And today, we are going to look at exactly how and why they did that. So let's talk about the massive clash and how we defined what's affordable, because it's wild. On one side, we have the absolute gold standard of personal finance, the 28% rule. This rule basically says you shouldn't spend more than 28% of your gross monthly income on housing if you actually want to live a comfortable life. But the bank operates in a totally different reality. They will happily approve you for a mortgage as long as your total debt-to-income ratio stays under 43%. Listen closely to this distinction because it is crucial. The bank's 43% threshold isn't a comfort guideline. Actually, scratch that. It's not a guideline at all. It is the absolute maximum financial stress they calculate you can endure before you just snap and default on the loan. They do not care if you have $0 left over for a vacation or an emergency. They just care that you make that minimum payment. To put that into perspective, there is a staggering $52,000 income gap between what the bank says you can afford and what you actually need to earn to comfortably buy a $400,000 house without completely destroying your quality of life. To comfortably afford that home under the safe 28% rule, you need to be making around $150,000 a year. But the bank, they'll rubber stamp you at just $98,000 a year. That $52,000 gap right there, that is where financial dreams turn into living nightmares. It's the gap where, sure, you are technically a homeowner, but you are effectively bankrupt in literally every other area of your life.
Let's look at the actual numbers, because this is where people really get tripped up. When you look at a real estate listing, you usually just see the principal and interest. On a $360,000 loan at current rates, that's roughly $2,150 a month. Sounds manageable, right? Well, hold on. When you stack on the necessary, unavoidable realities of owning that building, say a conservative $450 for property taxes, $300 for skyrocketing insurance, $275 for private mortgage insurance because maybe you didn't have 20% to put down, and $333 for a basic maintenance reserve, your true monthly burden completely spikes to $3,508. That is a massive leap from the base payment everyone initially focuses on.
And this brings us to a concept we call leftover shock. The crazy thing is, this applies even to high earners. Take a dual-income couple making $160,000 a year. Solidly upper middle class, right? They take home about $9,500 a month after taxes and retirement. But after sinking $4,367 into a $500,000 house and another $3,600 into mandatory life expenses, car payments, student loans, health insurance, groceries, look at what's remaining. They're left with just $1,533 for the entire month. That tiny little sliver has to cover clothing, kids' activities, unexpected car repairs, medical copays, and, the psychological need to occasionally leave the house and have fun. They own a home, but they literally cannot afford to live in it.
Beyond the intense financial drain, we really have to look at the complete loss of your free time. Think about it. When you rent and the dishwasher breaks, you send a quick email to your landlord and go about your Tuesday. It's not your problem. When you own, it becomes a weekend-ruining research project. You're suddenly watching YouTube plumbing tutorials at midnight. You're making 3 separate, increasingly desperate trips to the hardware store, all while trying not to get scammed by an emergency plumber. You effectively become an unpaid, highly stressed property manager for your own home. You have to ask yourself, what is your hourly rate worth? Because this hidden job is quietly draining your peace of mind. Okay, brace yourself, because this next number should absolutely blow your mind. On a standard $450,000 mortgage at a 6.5% interest rate over 30 years, you will pay
$573,840 in pure interest. Let that sink in for a second. You will pay more in interest to the bank than the entire original cost of the house itself. The bank is literally collecting more value from your hard labor than the physical asset was even worth. I mean, it is a brilliantly designed business model, if you happen to be the bank.
And when older generations ask you, well, why haven't you bought a house yet? You just point them directly to this reality check. They love to bring up the 18% interest rates of the 1980s, but the truth is, they bought in a completely different economic universe. Back in 1980, the median home price was just 3 times the median household income. Today, it's 5 times. Back then, they weren't graduating with $40,000 in student loan debt, and while their interest rates were undoubtedly sky high, the base purchase price was actually reachable. Plus, they could just refinance the rate down when it dropped. You cannot refinance a wildly inflated purchase price.
Let's talk about why the market you're trying to buy in right now is essentially frozen solid. Get this, 51% of all outstanding U.S. mortgages carry an interest rate below 4%. If someone locked in a 2.75% rate in 2021, they are holding a financial instrument that just does not exist anymore. Researchers estimate it costs an average of $65,000 in financial penalties just to trade an old mortgage for a new one today. So what happens? Nobody is selling. This freezes the housing supply entirely and has pushed the median age of a first-time homebuyer all the way up to 40 years old. Buying a full decade later than previous generations costs these buyers roughly $150,000 in lost lifetime equity. It's a massive hit. Now, this brings us to one of the most persistent myths in all of personal finance, the idea that renting is just throwing money away. We really need to unpack that because it completely ignores the massive unrecoverable costs of home ownership. When you buy, you are absolutely throwing money away on property taxes, homeowners insurance, HOA fees, maintenance, and, as we just saw, tens of thousands of dollars in interest. In fact, for the first 5 to 7 years of a standard 30-year mortgage, practically none of your payment goes toward the principal. You are basically just renting the money from the bank. It is the exact same concept as renting a physical apartment, just rebranded to sound like an investment. And the toll here isn't just financial, it's deeply, deeply psychological. There's this fascinating 2019 academic study from the Proceedings of the National Academy of Sciences showing that debt physically impairs your cognitive functioning. When debts were eliminated, researchers saw clinical anxiety symptoms plummet by a massive 25 percentage points. The absolutely crucial finding here, the brain doesn't care about the specific dollar amount of the relief, it cares about the open tab. A 30-year mortgage is the ultimate open tab. It hums in the background of your life 24/7, keeping you in a constant state of low-grade anxiety that you don't even realize is there until it's finally gone. Because of that open tab, homeowners often get forced into what we call the golden handcuffs. Having this massive, immovable debt severely suppresses your lifetime earning potential. Why? Because every single time you want to take a career risk, start a new business, or leave a totally toxic boss, that invisible hand on your shoulder asks, wait, can we still make the mortgage payment? If a competitor 2 states over offers a 35% pay bump, a renter just gives their 30-day notice, packs up, and takes the money. But the homeowner? They're paralyzed. They're worried about realtor fees, prepping the house for sale, and giving up that precious low interest rate. They are literally tethered to their local job market. So, let's bring it back to those 2 neighbors side by side to really drive this home. Neighbor A bought the $500,000 house and is sweating bullets every single time the property tax assessment arrives in the mail. They are stressed, they are trapped. But neighbor B? They're renting a slightly smaller place down the street for $2,500 less per month than A's total cost of ownership. Neighbor B is taking 2 actual vacations a year, sleeping a solid 8 hours a night, and keeping their net worth completely liquid. Neighbor B isn't failing at the American dream by renting, they have actually outsmarted it by remaining untethered and super adaptable. And here is the absolute game changer, the wealth engine that Neighbor B is using. If you take that roughly $2,000 a month saved by renting instead of buying that expensive house, and you automatically redirect it into a basic S&P 500 index fund at an 8% historical return, watch what happens. In 20 years, that money compounds to over $1.17 million. You only contributed about $480,000 of your own hard-earned money, and the market rewarded your flexibility by handing you nearly $700,000 in pure compound growth. Let me tell you, the bank definitely does not want you doing this math because their mortgage product is the exact hurdle keeping you from that $1.17 million. So what's the game plan? How do you escape? Well, whether you are already trapped in a mortgage or actively trying to decide whether to rent, these mathematical steps are your way out.
If you already own, step 1 is simple. Switch to biweekly payments. This gives you 13 payments a year and effortlessly shaves 5 to 6 years off the loan. Step 2, if you can swing it, is throwing an extra $1,000 a month directly at the principal to nearly halve the loan term. But Step 3 is for those completely stepping out of the matrix. By choosing to rent and dropping your mandatory survival expenses by $2,000 a month, you instantly lower the amount of money you need to achieve total financial independence by a staggering $600,000. You are literally changing what survival costs.
To wrap up this explainer, I really want to leave you with a provocative thought. I want you to look closely at the reality of your housing costs and ask yourself, are you building real tangible wealth, or are you just acting as a walking subsidy for the banking industry? Is the cultural illusion of success, the granite countertops and the 30-year mortgage, really worth sacrificing your mental health and your absolute freedom? Or is it perhaps time to stop feeding the bank, embrace the incredible flexibility of renting, and quietly build a massive liquid portfolio in the background instead? Ultimately, it's your math to run and your choice to make.